Welcome back to the Privatized Banking Project. Have you ever wondered how banks make billions, even in recession, while most people struggle to earn a few percent on their savings? Today, we're pulling back the curtain on how banks really make money, and more importantly, how you can ethically apply the same principles to build financial freedom on your own terms. Because once you understand the banking model, you realize you don't have to be a bank to think like one. First, banks don't make money by holding your money. They profit by moving it. When you deposit your paycheck into a savings or checking account, that bank doesn't keep it in a vault. They immediately redeploy those dollars into loans, mortgages, car loans, business lines of credit, charging borrowers much higher rates than what they pay you. This spread, called net interest margin, is where the magic happens. For example, they might pay you 0.01% on your deposit and lend that money out at 6%. That's a 5.99% spread earned off your capital. Second, they profit from fees and friction. Banks engineer systems where they get paid whether you win or lose. Overdrafts, late fees, account fees, these are highly scalable income streams. For large institutions, fees alone generate billions annually. But here's what's more important. These profits are consistent, automated, and detached from labor. That's the model worth studying. Another powerful reason banks win is leverage. Through fractional reserve banking, they're legally allowed to lend more than they actually hold. In the US, for every $1 deposited, a bank might lend out $8 to $10 or more, amplifying their returns. They turn a little capital into a big engine for cash flow. You're told to stay out of debt, but the bank is using your money to scale their debt-based assets. So how can you use this model yourself without becoming a bank? Here's how. First, become the allocator, not the accumulator. Banks don't save for growth. They deploy capital strategically. Instead of parking cash in low-yield savings, look at assets that generate cash flow and appreciation. Private lending, dividend stocks, income real estate, or even owning small businesses. It's not about chasing risky returns. It's about understanding velocity. Second, use controlled leverage wisely. Just like banks, you can borrow capital at a lower cost and invest it at a higher return, but only when it's backed by cash flow. Think about using business lines of credit, real estate equity, or policy loans, if used responsibly and not as a gimmick, to amplify returns without gambling. Key is risk management, not raw aggression. Third, build systems that pay you, not just pay off. Banks earn recurring income from interest and fees. You can build similar systems through recurring revenue, rental income, royalties, high-yield lending, or even digital products. The more your money works, the less you have to. And finally, keep your capital in motion. A bank never lets money sit idle. They deploy, recycle, and reinvest constantly. You can adopt that same rhythm by building a simple, repeatable capital flow strategy where your dollars are always working, whether that's through real estate, lending, business, or alternative income streams. The goal isn't complexity, it's control. So here's the bottom line. Banks don't have secret access to magic money. They operate on principles that you can learn, adapt, and apply if you think like an owner, not just a consumer. That's what this channel is about, helping you build your financial intelligence that leads to real freedom. If this sparks something for you, I want to hear about it. Drop a comment below. Which banking principle are you most interested in applying to your own strategy? And if you want more content like this, where we cut through hype and give you the real tools to build wealth, subscribe, like this video, and share it with someone who's still stuck trusting the system that profits from their confusion. Because the true financial freedom doesn't come from saving. It comes from owning the system you used to be trapped in.